Take a look at the broker research reports in recent months, and it's hard to find an analyst who isn't bullish on gold. Year-to-date prices for the world's foremost precious metal are up more than 30% in benchmark US dollar terms, recently consolidating at all-time highs north of $2,600 an ounce. As one of the most talked about asset classes in global markets, whenever gold prices get on the move, there's no shortage of theories about what's driving the price action. Historically speaking, gold has always been viewed as a sound inflation hedge, although gold prices have continued to surge this year, even as the US central bank cut interest rates. But perhaps another, more simple reason can explain this year's price action. Plenty of buyers and not many sellers. And in this case, the buyers have some serious firepower. Global central banks have been on a gold buying spree of late, led by the People's Bank of China, which has been loading up the truck since late 2022. Data from the World Gold Council shows that of the more than 1,000 metric tons of gold acquired by central banks last year, China snapped up more gold than all the other central banks combined. The Chinese buying spree continued into 2024 and has only slowed up lately, perhaps waiting for prices to cool off a bit before re-entering the market. The reasons for all this central bank buying are again many and varied, but multiple analysts have pointed to the riskier geopolitical backdrop and increased tensions between the US and China, the world's two economic superpowers. For ASX investors trying to piece the gold puzzle together, perhaps one factor is the most important. Short-term price action aside, how have recent trends affected the long-run outlook for gold prices? After all, it's the long-run price that ASX juniors need to rely on to make their projects economic. On that front, recent research from Goldman Sachs noted that with the run-up in gold prices, many ASX goldies are being valued based on long-term prices around $1,800 an ounce. So if the long-term price holds at current levels above $2,500 or pushes higher, it means the ASX gold space is being significantly undervalued. It also elevates the scope for companies like emerging microcaps Vertex Minerals and Aguia Resources to capitalise on this market of opportunity. For Vertex Minerals, the ascending gold price has coincided with the company's rapid acceleration from exploration to the development of its high-grade Reward gold mine, part of the historic Hill End project, where the largest piece of gold reef ever discovered, the 286 kilo Halterman Bayer nugget, was found in 1872. The Reward mine sits below the famous Hawkins Hill mine, home of the Halterman Bayer nugget, and the building blocks for project development are already in place, an excellent outcome for a deposit that hosts 419,000 tonnes at 16.7 grams per tonne gold, including 225,000 ounces of contained gold. Vertex has consistently emphasised the uniqueness of the ore body, not only because of its incredibly high grades, but due to the fact that it can be recovered solely by gravity, positioning the mine for a simple, low-cost startup. Importantly, there is significant mine development potential at Reward within the envelope of highly prospective bonanza-grade gold targets, which are expected to be amenable to simple gravity recovery processes. Simply put, no chemicals are required to recover the gold, meaning there is a clear pathway for Hill End to develop into a low environmental impact gold producer. With a newly refurbished processing plant, Vertex recently poured its first gold bar and is well positioned to generate near-term cash flows from the processing of existing ore stockpiles at Hill End. And with gold prices at record highs, that's likely to underpin plenty of upside potential alongside the ongoing development of the Reward mine, a key catalyst for a company that is becoming increasingly recognised as one of the most exciting emerging high-grade gold producers on the ASX. Separately, Aguia's recent acquisition of Andean Mining has shown how the value of the precious metal can underpin a company's corporate growth. The Andean acquisition added significant diversity to Aguia's portfolio, with gold, silver and copper projects added to its asset base, but the prize among those is the Santa Barbara gold project in Colombia. As the acquisition was finalised, Santa Barbara was viewed as a near-term cash-generating gold asset with considerable exploration upside, a concept completely aligned to a surging gold price. The market's response to Aguia's pivot towards gold was swift, with its share price doubling since the acquisition was finalised in August. Dubbed as potentially one of the highest grade, lowest cost gold projects in the world, with in-situ grades of up to 30 grams per tonne, its analogy with the nearby Buriticá gold mine, Buriticá, with its approximately 350,000 ounces per annum and 8 million ounces in resources, is a strong indicator to the large gold endowment in Colombia's lucrative Bolivar gold district. Furthermore, the project has been de-risked by the 30 tonne per day pilot plant that has treated 500 tonnes of ore, with average recoveries of 20 grams per tonne gold plus silver, and the plant is set to be recommissioned later this year with plans to increase plant capacity to 50 tonnes per day. In tandem, Aguia is on schedule to commence underground operations and the processing of the mineralised exploration material, meaning that it is uniquely poised to fully capitalise on the gold surge. Right now, the gold price is showing no signs of slowing down. While other commodities are scrambling, it is the likes of Vertex and Aguia that are showing how unique projects and proactive approaches can be a vital point of difference in a gold bull market.